We've got CGT at the forefront of our mind, capital gain discounts, and how it's going to apply and where it should be applicable. We've got a lovely gentleman, Bruce, who's in his mid-60s and is really wanting to understand the later stages of a career and what tax he can look at saving and what tax implications there would be on one of the sale of his investment properties. He's semi-retired and he's looking to slow down and he's looking for the finer things and enjoy what life has in store for him in his next stage. But the questions really relate to him wanting to sell his property, when he should do it, capital gain taxing dates, what ways he can minimise his capital gain tax. If you've watched our prior shows, you'll hear all about how we minimise CGT, but this is going to be putting it in a real life example for someone in their mid-60s, what they should be doing to reduce their capital gain tax. If you've got a question you want answered on the show, click on the link in the show notes below. Tell us a bit about it and you and I could be chatting on this show. This is what schools should have taught you. Let's get into the question with Bruce about CGT.
Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy Iannuzzelli will be sharing his lessons on everything school should have taught you so you can build the life you want.
Welcome to What Schools Should Have Taught You, a podcast where I share with you all the lessons you need to know about building true wealth. We've got a very exciting person on the line with us today, Bruce, and he's at the later stages of his career, wanting to understand a little bit more about what he should be doing with his money, how he can save his tax and enjoy his retirement. Bruce, I'd like to welcome you to the show. How are we going?
Yeah, very well, Jeremy. And thank you very much for the welcome. And going well. And you're well?
Mate, very well. Happy and healthy and in a new financial year. So it's an accountant's heyday at the moment. But mate, you've got a very interesting question to ask us here on this show. And I think this question is going to relate to a lot of people in your circumstance and a lot of people in your age group as well who are wanting to know, what am I going to be doing now to make sure that I've got a healthy funded retirement? So Bruce, if you would like to share with our listeners today your question, and mate, we'll go back and forth with some other questions and hopefully some other answers to get you on the right path moving forward.
For sure. Okay. I've been given some advice from our financial advisor, and I just want to run it past you guys and just check and see there's another way of doing it or it's the best way of doing it. I've recently semi-retired about 18 months ago. I'm about 6 months short of 67, and my wife wants to retire in about another 12 months, or semi-retire in about another 12 months. We've got a couple of investment properties. We're wanting to sell one at the moment, and capital gains tax, that scares hell out of us. We've had the property for about 10 years. I think we paid around about $350 for it, and it's probably worth around about $650 to $700. And as I said, the capital gains, you look at that and it's going to be a lot of money. And the way I've been told to limit that as much as possible is put as much money as we can out of the profit into superannuation. How does that sit with you? Does it sound about right?
Yeah, well, look, we'll go through a couple little things first because we've got to understand the way that you own the property to then determine where that goes. So the property that you're looking at selling in the next 6 months, you paid $350 as a purchase price. I'm sure there's a couple of expenses like stamp duty and incidentals, but who owns the property, Bruce? Do you own it or do you and your wife own the property?
It's in joint names. Basically, everything that we've got is in joint.
Beautiful. And you mentioned you're semi-retired and your wife at the moment is working towards her retirement. Is that correct?
Yeah, and she works for herself and I help her out. That's why I'm only semi-retired. I help her out a little bit in her business as well.
Fantastic. All right. So there's a couple things that come to mind straight away. If you're helping your wife out in her business, obviously there might be some remuneration there that you're receiving for the assistance, which could be, wages that she pays you. There's a concept called the 5-year carried forward concessional contribution rule, Bruce, which allows you to go back up to 5 years, including excluding the year that you're in. So it's almost like 6 years. It's this year and 5 years prior to it, and allows you to go back to contribute and top up all the unused concessional contribution limits that you had. So
right, I have heard of that.
Yeah, so it's a very strong way to get a significant amount of money into super for you, Bruce, and also for your wife. So if we're looking at, say, give or take a $350,000 profit Now those numbers will slightly come down as you increase the cost base for the stamp duty and incidentals and you take away the selling cost. But let's say, argument's sake, you've made a $300,000 profit in this particular circumstance. Straight away, we're going to get a 50% discount for it. So that's number one. So that's
because we share. Sorry for interrupting. That's because we share the profit.
No. So you get a 50% discount on the basis that you hold the investment for longer than 12 months. So out of that 300,000 profit that you've generated, 150 of that goes into your back pocket, Bruce, both yourself and wife's back pocket, I should say, as tax-free. So that's brilliant. Then secondly, after we had that 150 grand go into our back pockets as tax-free, the other 150,000 will be split equally, 50-50. Again, you'll confirm and base this on the copy of the contract of purchase, but that will get split between both yourself and your wife. So that's going to be $75,000 each that gets added onto your taxable income. Now, with a bit of tax planning, in mind, again, depending on the year that your wife has in her small business and depending on how many wages, or how much wages, I should say, she pays you, that could put you guys at a very level amount of income that you earn. Now, if you've each got, say, for argument's sake, 50 or 60 or 70 grand worth of carried forward concessional contributions, you could contribute equivalent to what you're receiving each of a net capital gain, which is 75 grand each. You could contribute that amount of money directly into your superannuation, Bruce, and your capital gain tax would be nil.
Okay, so we could turn around and, providing we haven't, so I think from memory we were doing when I was working full time around about $15,000 into super each per year. So that would mean we would have something up our sleeve then.
Absolutely.
For the last 5 years.
You could have at least $15,000 to maybe $17,500 as a provision each year for the years that you haven't contributed up to the cap. Now, you take that $15,000 potentially as a minimum over 5 years, there's your $75,000. And that $75,000 contribution into super will then negate and pretty much wipe out all of the profit that you've generated from the capital gain after taking into account the discount. So it actually is not as scary as you think in terms of the amount of money you might have to pay in capital gain tax. You just got to get that piece right around the 5-year carried forward concessional contribution rule. It is on the back of, and it is very important that your prior year balance of your super must not exceed $500,000, Bruce. Very important to understand how much the balance of your super is before you make that 5-year carried forward concessional contribution amount.
Okay, but combined we're just under $1 million.
Okay, so combined being under $1 million is probably fine, but it's what your respective balances are. So if your balance, say, as of last financial year in your super fund is $600,000, then you might not have the opportunity to utilise the 5-year carried forward concessional contribution rule. But for instance, if your wife is $400,000 as of her last year's financial balance, then there is an opportunity where she can maybe reduce a substantial amount of the capital gain tax by doing the 5-year carried forward concessional contribution rule.
Right.
So that is definitely something for you to have a bit of a look at, and also make sure that you're consulting with the financial planner to get exactly what your balances are as of the prior financial year. If they are below 500,000, you've definitely got the access to the 5-year carried forward concessional contribution rule.
Excellent. Provide that, so we got access to all that, and as you said, in the dollars, obviously ballpark figures of what you've just mentioned, almost null and void capital gains.
Absolutely it can, because you are assisting your wife. Obviously in her work, and sometimes we do it for love and sometimes we do it to get a little bit of pocket money. You might want to look at being commercially remunerated for the services that you are providing your wife's business, Bruce, because things need to be done at arm's length distance. We can't just pluck a number out of the air and then partake in what they call a Part 4A tax avoidance rule, because the tax office do look at this very carefully. But in most circumstances, when I see family members all working for each other, most commonly they're never commercially remunerated, never. And you might want to apply a commercial rate to the time that you're spending on behalf of assisting your wife. And that is a way that potentially you can reduce the amount of profit or income that your wife is making from her small business. And that gives you an opportunity of spreading out more of the tax the right way, the legal way, without doing things obviously illegally, of course.
Yeah, we don't want to be doing that. I don't want to end up in jail at 67 years old.
Correct. And very important, the timing of the sale becomes very important too. And this is again about timing of when you have to pay the tax. Capital gain tax, Bruce, it's calculated based upon the date of contract, not when the property settles or not when it goes in an unconditional exchange, but when you've signed the contract and it's been countersigned by the other person. There'd be a date on the contract, and that is when the capital gain event occurs. So if you want,
right? right.
Yeah, so if you want to get that capital gain event to occur in the current financial year that we're in, well, you'll sell it between July and June and date the contract accordingly. But what many people do, especially if they're looking to sell a property towards the end of the financial year, they might try to work out a way where they put the property on the market quite late in the financial year, Bruce, and then they're actually selling the property and dating the contract in July. And by doing it in July, what it does do is it means that you get to hold a bit of that profit in your bank accounts much longer, because the capital gain tax is not due until 15th of May following the financial year ending, when the sale actually occurred. So for argument's sake, if you were to sell the property today, being July of 2024, that tax would be payable in May of 2025. If you sell the property in July of 2025, then the tax payable would not be paid and due until May of 2026. So it does mean you are getting the money in your bank account working for you for a lot longer period of time.
A lot longer.
Yeah, that's something you may want to consider. The tax doesn't change. You still may have to pay the tax and the taxes will be due, but at least you're getting access to that level of capital for you to generate some level of return, or you might want to put that into an offset account, reducing any interest you're paying on any other investments for a lot longer. Now, Bruce, do you have any other investments that are currently in your portfolio other than the one you're looking to sell?
Yes, we have another investment property, and we're quite happy to keep that one. And what I was thinking of doing, if there's any money left over, is paying that down as much as possible, and almost to zero, either in an offset account or paying it off totally.
Beautiful.
In your opinion, is it better off putting it into an offset account against that property or paying it off?
Yeah, the age-old question, do we pay it off or put the money in the offset account? Now, it's what makes you comfortable, but I'll give you a particular example of what I would do. Now, I would have the money in the offset account because, to me, putting money in an offset account and reducing interest is essentially almost like paying off the debt anyways. But if you pay off the debt, and I've seen this happen to many people, especially later in their working careers, if you pay off the property, it's very hard to then go back to that property to extract equity in the future. And let's say there might be, some help you want to give your children. You might want to go on a very big, nice holiday. You might want to, there might be a great opportunity for you to put some money in and potentially invest a little bit in your retirement. Once you pay off that home, for you then to go back to the bank, you've got to go through the whole lending process again. And you might not have access to being able to obtain funding. They might want more information. They might give you a harsher rate. So typically speaking, I will say, on my own example, I would have the money in the offset account. It's doing what I want it to do anyways, which is reducing the amount of interest that I pay. And I've got full right in knowing that at any point in time, if I wake up in a hot sweat at night, I can just plonk that money into the loan, close it, and get the title deed in my top drawer.
And there it is,
So that cash is important.
At the moment, the house we live in and have done for a while, we've owned that for quite some time.
Beautiful.
And we still have an offset account on that, even though we don't owe any money on the house. So we've got that up our sleeve. So would you still do that with the other investment property if you've got the guarantee of having access to other money? Is that
absolutely
what you think?
Absolutely, mate. Because again, your whole goal of putting money in an offset account is to reduce the amount of interest that you pay. And if you can have enough cash equivalent to that loan offsetting, and then obviously no interest being paid, it gives you ample opportunity that if there is something there in the future that you find or see as a great opportunity to invest in, you've got the capital to do so and move it and get into that investment as quickly as you need to. So I think options, mate, no matter how old or how young we are, more options we have as an individual, more opportunities that provides us. And then ultimately it gives you, a little bit more free flowing money, depending on, different things that may occur towards your retirement phase or retirement age. One thing, obviously, in your circumstances, Bruce, to make note of is it sounds to me like you could be over the asset range in terms of obtaining a full pension or part pension. But as you start to deplete your assets, you might use it for spending and holidays, other things. Just keep note of the change in scale of the asset range that you can have as an individual or a couple, because you might be eligible for a part pension, may not be a full pension, but might be eligible for a part pension as potentially you start to downsize and sell off your assets into the future. But what you've done is a very textbook way that I see many investors is they'll hold hold their assets for as long as they possibly can, and towards retirement, when their income's at the lowest point that it possibly could be, that's when they take the opportunity to sell and boost up super if they've got an opportunity of doing that, number one. Or number two, it's where they'll pay the least amount of tax because it's not getting added, the capital gain that is not getting added to any income that they're earning on top of their wages.
Yeah. And being that both my wife and I are over 60 at the moment, we still have access to that superannuation money if need be as well, don't we?
Absolutely, you do. So you can start to dip into your superannuation at certain times once you reach that preservation age. But your goal is you want to try to leave as much of it as you can in there, Bruce. I think
for the children.
No, for you, mate. No, for the children.
Right.
I think I'm a big fan. You look after yourself first, and you make all the right decisions for you and your wife, and the children will benefit from that when their time comes. When their time comes, I feel that my father uses this term called elderly abuse. So many kids now, we abuse our adults. We dip into their retirement savings for properties, or we may dip into it to pay for weddings. There's so many things that our parents help us with long after we've moved out of the home and become adults ourselves. But I'm a big fan is you get that mask, that oxygen mask on yourself. You enjoy your retirement. You use the money the way it was intended for, which was to give you and your wife a fantastic retirement. And what the kids get left behind, I'm sure, will be far greater than even they think of, as all your assets or potentially savings or your own home grows in the background. So look after you, and the kids will be looked after, I'm sure, later on. But from your
sure they will. They won't miss out.
No, but from your point of view, mate, what I would probably look to consider is that if you have an opportunity with the assets that you have of maybe waiting and picking the right time to sell, don't be too rushed into it. At the same time, work with the financial planner to make sure that you consider all the aspects around the 5-year concessional contribution rule. You still will be able to contribute super up to that $27,500 or $30,000, which it is now, being 1 July 2024, Bruce. So there still is going to be an opportunity to contribute a bit of super, and that could bring the marginal tax rate down, which means you are paying less tax as a percentage. What you want to have a think about, though, Bruce, is when to convert your super fund to pension phase. That's a very important thing to consider. Now, again, working with the people around you, the professionals you've got, most people, and not all, but most of my clients will try to keep their super fund in accumulation phase for as long as they can, because they might have income that they're generating from working or businesses or investments, and they see it as an opportunity to still only pay 15% tax and keep the super fund growing. Because once you convert that portion of the super fund to pension phase, you will be required by the SIS Act to withdraw the minimum amount each year. Now,
and the minimum amount is?
Minimum amount is, I think, ranging at 4 or 4.5%, and it does start to really ratchet up, Bruce, as you start to become older. So I think once you get to your late 80s or early 90s, I think it ratchets up to about a minimum 10% withdrawal or plus each year. And again, that's subject to today's legislation. That may change in the future. But ideally, when you convert your super fund to pension phase, yes, any earnings the super fund makes is tax-free. But given the environment of super being so low as a tax rate, only 15%, sometimes the ability to contribute more into super from some free-flowing cash that you might have, that will give you an opportunity to build it up larger. And then ultimately, when you do convert it to pension phase, you've got more money invested, hopefully doing very well, surpassing in terms of returns the minimum amount of withdrawal that you need to make. So there is some opportunity there for you and your lovely wife to be able to really get things right over the next 2, 3, 4 or 5 years, and make sure that you strategically put in your individual super funds into pension phase at the right time when you need to, knowing the market that you're going into and the economic environment around you.
It's a long game, isn't it?
It is, mate. And there's no right or wrong answer. Everyone's got a different situation that will apply different circumstances. But I think the more, today's great. It gives you a couple of questions to ask, especially around the 5-year carried forward concessional contribution rule and the timing of the sale and obtaining the 50% discount, which is always a great thing to have. It's a fantastic concession. And then the strategy around when to convert your super fund into pension phase becomes significant for you and your wife for 2 reasons: earnings being tax-free and the minimum amount of withdrawal. But you could determine that leaving your super fund in accumulation phase might be more beneficial for you both. It means you can start to inject a bit more money into super if you need to. But again, your financial planner will become your best friend. Your accountant, Bruce, will become your best friend. They're the 2 people you're going to lean on for financial and tax advice to make sure more of the money that you're earning, more of this hard-earned dollars that you've been contributing to super, stays in your back pocket and not somebody else's.
For sure. We got to be upfront and pay our taxes, but we don't want to give them too much, do we?
Absolutely, mate, because the old Kerry Packer, as he said, I'm happy to pay my taxes as everybody should, but it's un-Australian to pay more and to give you buggers more money because you're not using it the right way from what he saw.
Yeah, if they spend it wisely, it might be different.
Absolutely. Bruce, mate, is there anything else I can give you a bit of assistance with? It sounds like you're very much on the right path. There could be a couple other questions I think you need to ask and more strategies that you need to implement, especially around the retirement side. But is there anything else that we can help you with today? What school should have taught you?
No, I think that's all covered. It was mainly the capital gains that we were concerned about. You hear stories about people making, look at all the money that bloke put up the street on that house, but what you find, see the capital gains he paid, and it's all hearsay. And our financial lady has said very much along the lines of what you've just suggested. So it reinforces what she's saying, and
beautiful.
I think we're heading down the right track.
Beautiful, mate. Well, all the best. I wish you all the best for the impending sale of your property. Congratulations. Thank you for calling in the show and asking your question, because I'm sure a lot of people are going to get the value out of what you've asked today, and there's many people in your situation. So, Bruce, we wish you all the best moving forward. Thank you very much for your question and coming on the show today. It's been an absolute pleasure.
And thank you very much for your advice, and good luck for the future, Jeremy.
Thank you.
Bye-bye.